2021 was the best year for the Indian capital markets over the past decade, during which the corporates have raised more than $14 billion through IPO. Every IPO cycle in India over the past decade has brought one new sector to the fore. It was about the real estate in 2010. It was about the insurance sector in 2017. And this time around, it is about the technology unicorns. The new age technology unicorns have raised constitute almost 40% of the total capital raised through IPOs this year. And it's not over yet. There's a very, very healthy pipeline of the unicorns looking to list on the markets. Looking at the sector, if we look at the private space, Indian internet unicorns are already the third highest valued on an aggregate in the world, and this is only next to US and China. Valued at about $150 billion, or we can say roughly about 5% of the total listed market cap, the unicorns have attracted more money, close to almost $80 billion over the past 7 years, which is more than the foreign inflows that the whole of the listed market has received. So in simple terms, we can see that when adjusted for size, the unicorns have attracted almost 20 times more money than the whole of listed markets. This is phenomenal. As in, like, it is not without a reason that like India internet sector is where China was 5 years ago. With half of the population now having access to internet, rising household incomes, and in many ways, the journey has just begun, and we have a very, very long runway of growth. Now, coming to the markets, the success of these IPOs on the domestic bourses is not just a validation of India's digital growth potential. It is also a testimony of investor appetite, the changing, the capital market reforms, the deepening of the capital markets, and the changing role of regulator and exchanges in the new era. Hello, my name is Rajat. I am an Asia equity strategist with Societe Generale, and today I am here in this panel discussion about the new Indian IPO cycle, the changing role of regulators, to talk about the technology unicorns. To discuss all this and much more, I have with me a fantastic panel. We have with us today Jibi Jacob, who is Managing Director and Head Capital Markets at Edelweiss Wealth Management. He has worked across the entire value chain of the IPO deals, advised multiple corporates, and has led fundraising across multiple sectors. We have with us Rachana Bhusari. She's the Head of Primary Markets Business Development at National Stock Exchange. Rachana is responsible for business development initiatives of NSE for listing of equity and debt for corporates, startups, SMEs, and Gift City. She has wide-ranging experience in business development, regulatory, and operational roles, and she presents the exchange in multiple committees, advisory groups of the regulator. We also have with us Mohan Bhuyan, who looks at global capital markets, primary capital markets. He has led the London Stock Exchange primary markets business development activities in India since 2018. He has held managerial and leadership roles in advertising, business, public relations, and sales and marketing earlier in his career. So let me start with Rachana. Rachana, you have seen this capital market, Indian capital markets, evolving over the past almost 2 decades. What do you think? What do you think of the current IPO cycle, and what do you think is different this time?
Yeah. Thanks, Rajat, for introducing me and for setting the context of the panel discussion today. So, it's said that it's raining IPOs in 21 in India. And, it's just amazing to see this period and to be in this period when you have so many IPOs, and it's from the variety sector that is coming across. So India, we have seen around 53 issues in this calendar year that have got listed on the public markets, and they've raised more than 1,11,000 crores of funds. So that's an amazing fundraising that has happened during this year. And the growing number of unicorns that have come into this capital markets during this period is a testimony that the companies have come of age in India. The new economy companies have come on age in India, and it was felt that there is a need that you have to have differential behavior, differential framework for these kind of companies to get into the Indian capital markets. So since these companies have a very unique business model and they focus more on rapid growth and scalability than immediate profits, it was designed in such a manner, the framework has been designed in such a manner that you encourage these companies to list domestically and raise funds and help the wealth creation in this country as well. The regulatory framework was designed, and I think it's been well accepted, and it's a process which is being worked upon by SEBI from time to time basis to ensure that more and more companies get into this space and they're included towards the fundraising in the Indian markets. Like if you have to name a few on the top that comes to my mind is the introduction of the DVR, which helped these companies actually unlock value in India. Identifying companies which didn't have a promoter as companies which could be eligible to be listed in India. So these are the top two that I could talk about and say that yes, this changed the game plan of getting these companies listed in India rather than going overseas. The filings and I would say the current pipeline is also very strong to indicate that, yes, this is going to continue. This is not going to just stop in the December month. I would say this is just likely to continue because we have a strong pipeline of these companies and hoping for a successful IPOs from not only the new age companies, but also from the traditional businesses and brick and mortar companies that have been raising funds using the capital markets. Another different feature this was in this year 2021 was overwhelming response which these IPOs received, whether it was a new age companies or it was the traditional brick and mortar companies. We've seen like more than 300 times subscription in some of the IPOs, which is unprecedented. So that indicates very clearly that it's not only the companies which are tapping the public markets, the investor appetite has increased. There's an overwhelming response to these kind of IPOs, and again, the regulatory framework with respect to introduction of UPI, the ASBA facility or the EKYC has again brought in a lot of influx of the investors into this capital markets in India, supported by newer, I would say newer generation of investors coming into the capital markets. We see a lot of demat accounts opening. Again, this year has seen even unprecedented growth in number of demat accounts being opened up. So overall, I would say the framework has been designed in such a manner that it is different this year and be able to actually tap the investor potential as well as allow these companies to list and start their journey of wealth creation.
I think Rajat has frozen.
Rajat has frozen, yes.
Okay, I think I was next, and the question to me was, how do you see Indian capital markets vis-a-vis other EM markets or DM markets or developed markets, and what are the trends that have emerged this year in primary markets globally that may or may not be visible in India as well? So I'll just take over. I think to answer my own question, I think the Indian equity market stands out. Equity capital market stands out when compared to other emerging markets and compares rather favorably with most developed markets as well. In all my meetings, I'm always constantly referring to the Indian capital market as a market which is a well-developed one. It has a large institutional base of foreign as well as domestic institutional investors, including a large cohort of mutual funds. It has a good split now between institutional and retail. In the distant past, perhaps capital availability used to be a question, valuations used to be a question, question marks on those two things, but no longer so. We've seen extremely large IPOs and follow-on offers go through. We have seen later on this fiscal, we are going to see the mother of all IPOs hit the market, which is going to be Life Insurance Corporation of India. It could be raising upwards of $6 to $7 billion. We don't know, but that's quite a distinct possibility. And perhaps, obviously the market has great depth, but if there's one criticism that one often hears, especially from foreign investors, is that it has great breadth, but perhaps not as much depth, in the sense that, most foreign investors do say that, the investability of companies extends to the top 100 or the top 200 companies. Of course, that's getting better year by year. We are getting, as Rachana pointed out, extremely attractive companies joining the market every year. Now, coming to global equity market trends that may or may not be visible in India, let me start with the facts, the trends which are visible in India as well. So firstly, the focus of equity capital markets globally, which was recapitalization in 2020 in the face of the pandemic, has now changed, to IPOs and primary markets. And this year has been a phenomenal year, not just for India, but obviously for the US as well, for the UK as well. We've had about 111 IPOs so far this year, much more than recent years, marquee years like 2014, 2017, and we expect actually by the end of December to even cross the 2007 mark. About $21 billion have been raised. And even as far as India is concerned, the updated figure, I think we've already hit a century here, and $15.5 billion or equivalent in rupees has been raised. So that's the trend, recapitalization to IPOs. The other trend, of course, is the type of issuance. IPO issuance has changed. Investors are now preferring growth over yield. So tech or tech adjacent IPOs are ruling the roost. And we've seen a very strong tech IPO pipeline develop in India. The US, of course, has always been a strong tech market. But as far as India is concerned, as far as the UK is concerned, this year, tech has actually become a larger sector as well. So we've had about 35 tech IPOs. They've raised 40% of the total IPO proceeds, of 40% of about $22 billion have been raised by tech companies alone. And of course, the other trend, of course, is that the secondary sell down in IPOs has increased. What is known as OFS in India. So that's of course quite something that is likely to happen, because a lot of these companies which are coming to market are held by private equity, and private equity, as we all know, needs to have an exit at some point of time. The other thing that has changed, of course, is assets under management have changed. We are seeing very strong inflows into global equity funds, which are directed at equity investments, and that's to the tune of about $684 billion. So that has actually been the maximum. Is much more than the past 20 years combined. Of course, significant growth in retail investment. We are seeing that in India. We've seen that in the US. I was quite surprised to see that the retail investor participation in the US has increased by 100% over the last 2 years, and currently, they account for 23% of the volume. And this fact really astounded me when the statistic was sent to me, that now the retail volume is actually more than the combined volumes of both mutual funds and hedge funds in the US market. It's difficult to believe, but it's true. Similarly, in the UK, we have, for FTSE 100, we have like 5% average daily traded volume by retail. It increases as you go down the cap table. FTSE 250 is 20%. FTSE small cap is about 29%. Now, the other global trends which are not so visible in India are, of course, the predominance or the increasing importance of ESG funds which go into equity investment. Globally, that has increased. We are at round about the $600 billion mark and expected to cross the $1 trillion mark in ESG funds which are going into equity investment in a year or two. The number of funds in the US and Europe are in excess of 500. In China, that's about 120, but in India, that's only about 23 or 24. So there's much more development that can happen there. And the other phenomenon which has happened elsewhere, but thankfully not yet in India, for good reason, is the SPAC phenomenon. And it's actually mostly a US phenomenon, as you can see, but it's opening up in other places as well. In fact, the UK has recently reformed its SPAC regime, and now we are open to SPACs. It's kind of aligned with the SPAC regime in other jurisdictions as well. So that's about as far as the trends go. Back to Rajat. Is he back?
Yeah, I'm not sure, Mohan, if he's back. So what I can do is maybe kick off my session. I do remember Rajat talking about tech unicorns IPO in India, and I took the liberty of maybe putting a couple of slides up, in terms of how, as bankers, we are seeing the entire space, playing out. Yeah, just moving to the next slide. I think more importantly, a lot has been spoken about. Yeah, next slide, please. Spoken about, how the IPOs in India is at a record high. So I'll skip that part. More important is the ones which are, highlighted in the start there. If you look at the average deal sizes that India has seen over the last couple of decades, right? So if you look at in 2001, it was around, a very minuscule $3 million. In 2010, the average deal sizes were around 78 million. And whether it's 2020 or 2021, right, average deal sizes are north of now $200 to $250 million. Now that's a very welcome sign. You are seeing the market maturing. A lot of it has to also contributed by the the tech unicorn IPOs. But if I look at 2020, because 2021 saw a lot of the tech IPOs. If I look at 2020, and these are calendar years, though the number of deals were less than 1/3 of 21 YTD, the average deal size was very encouraging at $230 odd million. So we are seeing as banks, that trend to continue. And what gives us a lot of confidence, if you look at the next slide, is the financial sponsors kind of contributing more capital into India, and typically most of these IPOs are bought into the Indian capital markets by private equity players. And if you just look at the deployment that has happened into India, say 2010, average deal size was $18 million with around more than 400 deals, 455 to be precise, that has happened in 2010. If you look at 2020 and 2021, right, hovering close to around 800 to 1,000 deals. But the average deal size has moved up from 44 to $60 million, right? So obviously there are larger deals which are continuing to happen, but on an average basis, $60 million. What it kind of leads us to believe that going forward, subject to the secondary markets being in the current, tailwind as we are currently seeing, the average deal sizes will only notch up. A lot of that will be contributed by, as Rajat mentioned, 40% of this money has gone into, technology companies. So that will continue. But from an incoming foreign investors or the mutual funds in India, or retail and HNI, this is good news in terms of as a lead indicator of things to come by. Moving ahead, I think more specifically on the tech part of it, I'll skip the next slide, which is more about the macro that has been already spoken about, read a lot about how FPI inflow has been coming in big time. But I think the key question that was, will India continue to remain the preferred destination? And I think the answer is pretty straightforward. And this is to lead with a lot of the discussion that we have with promoters or private equity players. And one thing that really appeals to them is that if they look at India versus US, because that is the key destination that a lot of these technology companies at least look at, is that in India, more than $1 billion market cap, there are only 408 companies to be very precise. In US, there is more than 3,000 companies. So what you infer out of that is also the, IPO is just a one step into the transaction, but post IPO, you also want, how many number of analysts cover you and all of that. What we have seen is in India, when you're more than $1 billion, you will have around 30 plus research analysts of various banks covering you. The number is less than 1/5 in the US market, right? So do you get the right attention if you are a $1 billion, $2 billion market cap company? Our research, does throw in a light that the analyst coverage in US for a company of that size and scale would not be as much. The second part is also about the visibility. What kind of, products are you into? If you're a more B2C or a D2C as they call it, India is your home market. So, listing an IPO, what a IPO did for Nykaa or Zomato, and so on and so forth. I think it's a great brand building exercise. The retail investors and the whole ecosystem kind of takes up note versus a B2B company going and listing in US, which we also saw recently. So our belief is that India will continue as a preferred destination. And it's also do with two factors because, finally, it's about valuation. Are you getting rightly valued in India versus US? And also, is there investor appetite? Are all the key investors who invest into India or into US are investors into US as well? So if you move to the next slide, I think this gives you a bit of a peek into the valuations of how Indian companies are trading in. And if you look at, say, the first part of this slide, be it Snowflake, and these are only representative names, but I think it does drive a point home. If you look at Snowflake from a $34 billion market cap at IPO to right now at 108, but if you look at the revenue multiple, it's trading at 78 times. DoorDash from 7 times is trading at 10 times. Similarly, Airbnb IPO'd at 7 times revenue multiple, today trading at 16 times. Back home, it's not quite different. Nykaa, as we all know, it's trading at north of around 25 to 30 times. Zomato, similarly, 27, and India Mart, again at 26 times. So the valuation differential is not as much. In fact, we are seeing that India offers you a better valuation because it's finally a growth, country, and a growth multiple does get ascribed to it, which is in the next slide. This is slightly dated, but I think what important point is, if you just look at the ones highlighted in the red boxes, as we all know, tech companies are currently valued at EV by sales, EV by revenue, as you call it. On an average, they've been trading at around more than 20 times on an EV by revenue. And if you look at US companies, be it Zoom, be it Salesforce, which is the bottom part of the chart, the average revenue multiple is around 10 times. So the takeaway is that whether it is exactly 2 times or 1.5 times, it depends on the sector that you operate in, more or less, you are at least getting 2 times better value multiple than in US if you IPO in India. So that's a very strong point. And the last part of why India is on the next slide. It's about, are investors really looking at, India as a geography? So what we did was looked at all the key, leading, representative names and plotted all the key investors, a very representative name here again. Like, for example, the first name out there, majority investors in all the tech, IPOs in US. Similarly, do they invest in India? The answer is yes, right? So you will see all investors are a tick mark. So we are not necessarily saying that India covers all 100% of investor base, but it does cover the most meaningful of the material investors that, the IPO company would have got in US IPO versus an India IPO. Next slide, again, just a revalidation of the same point. We also looked at all the big tech companies out there listed, be it Microsoft, Apple, Alphabet, and so on and so forth. You look at the point which is highlighted in green, right? So the top, out of the top 10 higher, the largest shareholders, public shareholders in Microsoft, 9 of them are present in India. Apple, 9 of 10. So in all the scenarios, 9 of the top 10 investors in these global companies are directly investing into India. Now that is good news, right? I mean, one leg down from Make My Trip to the recent IPOs, the number is anywhere between 7 to 9 investors of these large firms are investors into India. So as I said, as a lead factor, private equity investing, check sizes have gone up, so the deal value should go up. Valuations are better in India, and also the large investors are present. So this I think all combination of all the macro factors does is a serious compelling reason why India will continue to be preferred listing of a destination for all the tech majors. Yeah, so maybe I'm done with my slides. There are a few more, but I'll kind of skip it in the interest of time. But over to you, Rajat.
So Jibi, maybe very quickly, what do you think gave these investors, gave these companies the confidence to list on the domestic bourses? So initially the plan was to list on the international exchanges, but then they finally chose to list on the domestic. So what gave them the confidence? After all, these were pretty large issues. As in, like, if you look at the history of the Indian capital markets, these were like ranging from 500 million to anywhere between 2 to 2.5 billions. So what do you think over there?
So Rajat, I think interesting question. As I said, maybe refer to a couple of the points that I made in the presentation. So we happened to take a company public 2.5 years back called India Mart. At that time, internet was not the buzzword, right? Yeah. And the company was valued roughly around say $50 million. In 2 years, when investors understood the story and the network play happening, the valuation zoomed to around $3.5 billion in just 2 years, right? Less than $500 million, moving to $2.5 to $3 billion. And as we all saw, a lot of these investors globally are also present in India, and as long as you're structured from a corporate perspective, domiciled in India, it makes a lot of sense. We are in a lot of discussions with corporates, which always thought foreign location or foreign destinations would be a right place. So they kind of domiciled the corporate entity outside of India, because then it becomes easy to flip into a foreign listing. But with the kind of trend we are seeing, people are kind of getting the structures flipped back into India to IPO in India. So again, that also talks about the valuation multiple, the investor interest, and so on and so forth.
Okay. Let me bring in Rachana here. Rachana, this is also about the investor appetite. So if you are wanting to list on the Indian markets, you would have also gauged the appetite of the investors towards these companies and the overall the investors' hunger for these companies. What do you think about that? How has the investor appetite changed?
See, investor appetite, we can actually demonstrate, it's been demonstrated in this current IPOs that, there is an overwhelming appetite for these kind of IPOs. And I think I would say all kind of IPOs, and with LIC also trying to come with planning to hit the markets, I think this is only going to increase domestically as well as for foreign industry. And the other thing is, our regulator has been quite proactive and, ensuring that we cover not only with respect to a framework which allows issuers to list easily, it has also made the framework quite friendly and easy, so that the foreign funds also are able to flow into India with entry barriers being lowered down, with ease of registrations, I would say, or the time frames being reduced for registrations. So I think all this adds to making India an important investing destination. And I think with China being not the preferred destination, again, India comes back as the preferred destination. And I think the regulators as well as the exchanges are very keenly working on this to ensure that we have the marqueest names in the Indian capital market ecosystem, so that the larger IPOs or the technology IPOs are actually not, hesitant to come on domestic bourses because of lack of investor appetite. So there's been a proactive approach by the exchanges as well as regulators to ensure that we have the largest of people coming in. And I think Jibi's slide was sufficient enough to show that, India is actually not lacking behind in getting the investors on board. So I think it's a good regime and it's an ongoing process. That's the best thing about the regulator and the Indian. It's an ongoing process which keeps reviewing and looking at things which need more and more, which need to be made more easier for people to access India.
Right. So talking about the foreign investors, as in they have access to pretty much all capital markets, and still we see a very strong interest from the foreign investors. So a part of the foreign investors are private equity investors who have already invested into these companies through the private equity space. But the foreign investors who are only looking at the secondary markets, for them, as in this is the opportunity. And if many of the an argument is that these companies are pretty expensive. Mohan, you also look at other capital markets. How do you see foreign investors' appetite in India at this point in time versus the other markets? And secondly, how do you compare overall Indian capital markets to other emerging market capital markets, or maybe some of the developed markets that you see?
Yes, indeed. And before I do that, I just wanted to endorse what Jibi also said about being a bigger fish in a smaller pond as far as tech IPOs go. We have seen that phenomenon in the UK as well, which is leading to our tech becoming overtaking things like energy and banking and financial services to become our largest sector for IPOs as well. So there's a scarcity value for such companies in markets like India and the UK. That leads to a scarcity premium, that leads to great valuations, premium valuations. It also leads to great demand in IPOs that we have seen. And therefore, hopefully, great demand in the aftermarket as well. Moving on to your question, yes, indeed. In the recent couple of IPOs, we have seen that foreign investors and retail, in a couple of them, have actually carried the book as compared to domestic institutional investors and high net worth individuals and what have you. We have also seen there have been some peculiarities in our market this year. Like we have seen that for anchor books have been covered a lot, mostly by foreign institutional investors. A lot of them, a great majority of them, 130 in some cases, 50, 60 are becoming regular as far as the number of anchor investors are concerned. And we've also seen that domestic institutional investors have probably not been as, in at least a couple of these, not been as favorable of that particular IPO. We've seen long-only IPOs, long-only investors seem to be flocking into the primary market. And I guess, we are seeing, but at the same time, we have seen that, investors in the secondary market have been net sellers. So there are certain peculiarities about this, and really the fact is that there's been a lot of the globe has been awash with liquidity, with quantitative easing. There's also the factor that globally most fixed income markets have very low yields, yielding to negative even. So there's a lot of money which is obviously found its way to India. So that is a good phenomenon. We hope that will continue. We don't know what's going to happen once the taper begins with the Fed, but I think the prognosis is good. I think we've seen that, and as far as this market is concerned, it is becoming very attractive to foreign investors. And as Rachana just referenced, with China apparently on the downswing right now, it can only be upwards for us. Back to you, Rajat.
All right. Yeah, no, indeed. I think it is not just about an IPO or a two. What we are seeing is that the foreign interest is actually very, very strong on all of these IPOs, and with a strong, healthy pipeline, we only see this evolving. Coming back to Rachana, discuss about this new regulatory regime, which has become much more adapted to the new era. Do you see, but at the end of it, as in many of these companies are, not profitable yet, they don't have a defined path to profitability. How are, investors perceiving this? Indian investors are not quite used to, investing into companies which are not yet profitable. They tend to look at the profit ratios, etc., very keenly. How do you think have the investors, responded to this not so profitable? And do you think that the regulatory regime will continue to be supportive of this factor, or will they give them a little bit of time to see how it evolves?
Yeah. I'll start with the regulatory regime part first, because I think, it's the journey, if I remember, started for facilitating these tech unicorns to choose India as a preferred destination for listing began somewhere in 2019. And, while SEBI has always been very consultative, the Indian regulator has been very consultative in their approach in getting the framework, the right framework put in place. A committee or a group was constituted comprising of the merchant bankers, the exchanges, and the founders to understand what was needed to have a better playground to facilitate these companies to list. And, these people all deliberated and discussed the matter with the co-founders and the counterparts countries. And accordingly, I think with various deliberations put in place, a framework was designed. And what emerged out of these deliberations was that we had to carve out a plan where you could fit in multiple categories of the needs that arose. So we had a category of people who were okay with the normal listing that was available in India. We had a category of people who wanted to list only using the QIB route. There were people who wanted the QIB route along with the DVR route, So then there were people, who were actually first time we came across that there were issuers, a group of issuers who didn't have an identifiable promoter. So they had a professional CEO running the business, and that was it. So actually, all these deliberations led to these categorizations, and then a fitment to these kind of categories was introduced through the regulatory interventions, which allowed these unicorns to tap, or I would say the new age economy companies to tap the Indian markets. So it's been a journey, and it's an evolution that has happened from 2019, because I think we all understood the fact that there are many companies which are in the pipeline, deadline, and they would be ready and ripe to list into the markets. So the preferred destination had to be India, and hence this kind of interventions, timely interventions with a lot of deliberations was made and introduced. Coming back to the investor part, I think, again, the maturity, I think I would say the confidence that the investors have reposed into the Indian markets, including the new age companies, has been again shown in the performances post-listing as well, and the subscription levels at the listing levels, pre-listing. I think Mohan mentioned a very good point about the anchor book being very attractive, and it's only increasing. If you look at it, was in the range of normally it's like 60 now. Earlier it used to be 25, 30 people participating in the anchor book, but it's from 60 to 140, 180. So that's again a very, very attractive, a significant differentiator, I would say, in these kind of companies and the Indian markets in the 2021.
And do you think the looking at the regulatory tightening around these IPOs in some other parts of the world, do you think the Indian regulator will remain supportive in the near term, or we could see some tightening in India as well?
I would say that the supportive role by the regulator and the exchanges would always be there. What would only happen is that, the takeaways and the experiences of these kind of listings will always help us to review the whole thing again, take steps if required. And I would say there would be always in the positive development of the markets, whether it is for the issuer or for the investor. So I'm saying is I would look at it from that perspective, that supportive role would continue. It would only be based on experiences and the takeaways that we have from our recent listings.
All right. Mohan, very quickly, again, comparing it to the other markets, like India's, low free float factor is the reason why Indian stocks have a low representation on the global benchmarks. Do you think this this IPO cycle and this momentum on the IPO is going to change that? So we have started to see Zomato start included in the MSCI benchmarks. So do you think this momentum should change or increase the representation of India on the global benchmarks?
I think so. The 3-4 factors here. Free float is of course one factor as far as index eligibility and the weightage is concerned. The other one could be liquidity. I think Zomato and people are pretty liquid in India, and there are extraneous factors. Other thing could be the prevalence or absence of DVR shares. Some indexes allow them, some don't. There are some extraneous factors like investment caps, taxes, what have you. But generally speaking, and there's of course as far as the FTSE Russell EM index or the MSCI EM index is concerned, there's this huge overweight that is China. So I think there could be a case to be made, for China having, just like Japan, its own index, and we can have an ex-China EM index as well, where India's weightage would automatically improve as well. The thing with that, increasing the free float, it's always a delicate balance between what an issuer wants and what the investor wants. Yeah. And in fact, what the index provider requires. So issuers generally want to have a lower free float at IPO because they don't want to dilute as much, but investors obviously want a higher free float.
Sure.
So
sure.
So actually, in the UK, just as a final point on this, in the UK, we have actually gone in the opposite direction last week. So where we had 25% free float requirement in the main market in the premium segment, we have actually now gone down to 10% in the main market at IPO. The FTSE Russell people are still consulting on that. We don't know whether 25%, which is required for index inclusion in the FTSE series, will also come down, but that is a possibility.
Sure. So before I move on to the next question for Jibi, maybe I would like to request the audience to log in their questions on the platform so that we could take a few. Jibi, this one is for you. No IPO cycle can be perfect. Not every IPO can although what we see is that like the listing premium on most of the listings have almost retained so far. It is not a boom and a burst kind of a scenario. So which means that the investors are staying put with these. But we did have some disappointments as well. Do you think that like this is going to dampen the sentiment on the current IPO cycle, and we could see a slowdown in the momentum, or do you think they should not be bothered much?
Yeah. No, so Rajat, I think on a lighter note, every time you see something of this kind, I think the mind kind of processes it as this time it is different, right? So it's a very dangerous word. But having said that, I think all of this stems from the liquidity which is available in the market, right? So any macro movement which kind of curtails the free flow of capital or the cheap capital, as they say, we'll see some kind of a corrections in valuations and so on and so forth. But I think if you look at the entire process, for a large IPO, you kind of meet around 300 odd investors, which are global asset managers and including large Indian asset managers. So the pricing per se is kind of basis the feedback that you kind of come by with all the big boys, quoting a valuation that is comfortable to all parties, and then you price the IPO. Now, some IPOs kind of list down, some IPOs, you also see in 100, 200% kind of returns. It is about a sentiment which is currently going on. But as I said, a lot of the long-only investors are extremely bullish. Now, I think the case in point has been a greatest success story, not only for India, but I think at global level has been Amazon. So if you can look at Amazon post listing, I think for 15 or 16 quarters, I'm not exactly sure, but I think it's around 17 quarters, they reported losses. And when they turned profitable from 18th to 20th quarter, the entire losses was wiped out with the profit on just that 2 or 3 quarters, right? I think It's a winner take all market. So investors are ready to back the Indian winners that they believe will kind of create that value. And we are, as investment bankers, very hopeful that same kind of play will kind of also see in India, where a lot of these large tech unicorns will get into the Nifty 50 as well. I think the time is just around the corner, and a lot of the indices weightage will also move into the tech unicorns. So not really, perturbed about 1 or 2 listings, maybe listing at say 5%, 10%, 20% down, because that will happen in each and every cycle, right? So I think currently the momentum, if you just look at December itself, from 1st December to maybe 30th, 31st of December, in the entire period, you would see maybe around 10 to 15 IPOs getting launched in India. I don't think that has ever happened. And these are all segment leaders by themselves. So the momentum is good. Obviously there will be a bit of corrections on valuations as secondary markets correct, but overall the trend is very positive, Rajat.
No, indeed, I think given the market size and the market potential, I think it is India is still a deeply underpenetrated market. So what investors are seeing is not just about the the current valuations, the current profitability, but they are looking at a big picture, 10 years down the line. Maybe I'll gather some last thoughts from Mohan about integration with the global markets. So India has been doing a lot to integrate with the international markets through the GIFT City. Another aspect could be the global integration of Indian capital markets is to allow the Indian companies to list overseas directly as primary listing. So far, Indian companies have listed overseas only as depository receipts. Can we see something, in the foreseeable future for something different?
Yes, indeed. What is known as the overseas direct equity listings and vice versa policy has been in the works for about 2 years now, and it is now expected to become effective hopefully next fiscal. There are some certain tax issues to do with the transfer of equity shares between overseas investors that need to be dealt with, and the government has said that they'll be legislating it with the budget legislation in February. That said, what is this policy we're going to do? And basically, as you rightly said, Indian companies have been restricted from IPOing overseas. They cannot do that by issuing their common equity shares overseas. At the moment, regulations only allow a primary listing in India first, and then a secondary listing through depository receipts if you want to have an overseas listing. So that is set to change, and what is going to happen is that Indian companies will be able to make primary issuances and have secondary listings as well as foreign companies will be able to do the reverse process. And we are expecting that, including Gift City, there'll be 5 or 6 other prominent international jurisdictions which will be allowed. And we're expecting that the US, UK, Germany, but possibly not Hong Kong, possibly not Singapore or Luxembourg, but these are the 5 or 6 jurisdictions which are going to be allowed. It's important to note like what is going to be possible. So like an Indian company will be able to do a primary issuance overseas. It will an Indian company already listed will be able to list it, have a secondary listing overseas on an overseas exchange by using its by listing its equity shares.
Sure.
An Indian company which has already had a primary listing will be able to then use this route to come back and list on NSE BSE, at some point in the future if its corporate strategy entails.
Okay.
There are very, very benefits to that. Are we going to see a rush to the exits from India? Absolutely not. I think this is going to be restricted to very niche companies with strategic reasons.
Let me take one quick question from an audience. The question is that like, if I understand correctly, is that like a strong retail participation is also quite a feature of this IPO cycle. And what could be the tipping point for retail participation on IPO? It's an interesting one. Who would like to take it? Maybe Jibi?
Should I go ahead?
Yeah, go ahead.
Yeah. No, so Rajat, yes, I think in the past, those kind of trends were clearly seen. But I think if you look at from an overall perspective, in terms of the yields, which is currently available in a bank's fixed deposit, it's negligible. So I don't think people have really, too many options in terms of deploying their savings into an yield generating, which also beats inflation. And we have seen in the past as well, even when, COVID crash happened March 20 to June 2020, I think retail there was an initial pullback, but I think the SIP flows have been continuously going strong. Today, I think it's very, very heartening to see around $1.4 billion of SIPs continuing flow into Indian mutual funds, right? I think those is as retail investment as it can come, because we are not talking about lump sum money coming into mutual funds. These are, retail investors putting in money. And I think we've been hovering around at $1 billion in the worst of cycles as well in the post-COVID. So don't really see a big, alarming fact that, okay, now retail has come into the market. So are we at the peak of a bull market? We are not necessarily looking at that from that perspective at all.
All right. And then maybe then just to conclude, I think, in my opinion, India is living its .com moment right now, and both the capital markets, the internet story, the digital growth story has come a long way. And it is not without the support of the regulators who have enabled corporates to raise large-sized capital. And as we discussed, that it is also about both the foreign and the domestic investors' appetite towards this new growth story. Essentially, as in like the stock investors are always looking for a new sector, a new growth story, which could run for another 5 to 10 years. And I think this is one such story. So overall, we think that like the technology unicorns will continue to gain a lot of favor with all kinds of investors in the foreseeable future, given a very large size opportunity in India. And at the same time, we think that the regulators and the exchanges should continue to provide support for enabling a healthy ecosystem for primary issuances. So thank you, everybody. Thank you all the panelists for sharing your expert insights on the subject, and thank you to all the audience for patiently listening in. Thank you.
Thank you.